Welcome to the weekly update, where I'll go over the action in the market for the week of February 20th through the 23rd, and then we'll see how things look for the week of February 26th through March 1st. We had another up week. Of course, a lot of that came in Thursday's session when NVIDIA reported their earnings right after the close on Wednesday. Things really took off to the upside, and instead of seeing a lot of selling into strength, we actually saw more buying. We were a little bit weaker in Friday's session, but we were still up by the time things closed. So this past week, the Dow and the S&P 500 have now set new all-time highs. The other indexes are holding up okay, but not quite there. The NASDAQ 100 is just a little bit below. We're watching the NASDAQ right now to see, can it create a new all-time high, or is the previous all-time high going to act as resistance, because we're really close to that level, and we're still seeing the mid caps and the small caps lag behind, even though there are times when they seem to be showing some improvement. Before I get started, please know that there's a PDF that's available in the description below every video that I post. Some of you find this helpful. Some of you, it's like, okay, this doesn't really apply to me, and that's fine. I just want to make that available to you. You can download this. You can follow along with the slides. You can see the charts perhaps a little bit clearer than what you see when you're watching the video. Also, I've launched a new video called What to Watch, and this can be a little confusing because I usually use for the daily videos a specific kind of thumbnail. And when I do this, I change it. It has a white background. But the idea behind this, I planned on launching this in 2024, was to just point out the things that are really speaking to us loudly. Now, this is prepared on an as-needed basis, but I'm kind of starting to work into a routine of preparing it in Monday's session before the market opens. We'll have to see. If a lot of things happen and some things change, I'll do another one. If not much happens that really is changing all that much, I may not do a video. The idea here is just to make a shorter video and just expose those things that are really speaking to us. But to get the whole context of what's going on, you need to watch the daily videos, the weekly videos, the intermarket analysis videos, and to a degree, even the deep dive video, because I'm pulling from all those different areas to create one big giant picture that we can use to then make decisions. And that's my approach to this whole thing. But feel free to check that out. And so far, it's been fairly successful. I've had some good feedback on it. If I miss something that you think I should talk about, please let me know. Or if there's something that you want me to address that's within the realm of what I cover in the other videos, please do. Everything that I go through in that video, I pull from other videos. So there's nothing really unique just to that video. It's just to kind of take everything together. Okay, pivot points are posted each day. This is a big deal right now. Even though I don't post the monthly pivot points on the weekly chart, that's a serious area that we're hitting right now. What I do on the community tab, only on the YouTube channel, is I post pivot points that apply for the whole month. And personally, I don't use those all that much, and I have a number of different ways that those are calculated. The ones that I use are the intraday, and those change every day. And that's what I also post there, and those can be quite helpful. Also, I do have a private Facebook group, not really active, not a lot of back and forth. Right now, really the only thing I do is I post a link in there after I'm getting ready to upload a video or after I've already loaded the video. I will be going through the results of the poll that was covering the previous week, and then I will be posting a new poll for the upcoming week. I'm really keeping a close eye on the YouTube comments. I have some garbage ones come in. I delete those right away. And I did go back a couple of months ago and actually delete some of the old comments, because sometimes you make valid comments, but I can't really reply to it. You're just kind of making a statement that doesn't really offer any feedback. And so periodically I'll go through and actually delete those. And I also post on Rumble as well as YouTube. I post on YouTube as well as Rumble. If you can't find me on one platform, feel free to go over and see if you can find me on the other platform. All right, let's go back and talk about this week's session. For the week, we were up 1.66%. Now, volume was below average. We did have a couple of independent days that were above average with volume, but because of the holiday on Monday, that skews everything for the entire week since there's one less trading day in the week. We're still positive now. We're looking overextended in the daily version of the charts that we look at. There are some things that are looking quite positive on the weekly charts. There's also some things giving us some concerns. And this coming week, it's going to be about inflation and interest rates. We've been keeping an eye on interest rates, but we're going to get the PCE report that comes out. And that's what the Fed really likes to look at as far as what is inflation really doing. We did have CPI week before last and then PPI, and that came in hotter than expected. So now the market's wondering, okay, what's the PCE, the core that we look at? What's that going to look like? And we also keep an eye on the different geopolitical events. But other than a little push here or there, either up or down, the market really hasn't been responding to that all that much. We did get some Fed speak this last week that I'll refer to that's kind of confirming the idea that the Fed's done raising rates and that they're going to cut them, not right now, but possibly at some point in the future. Our trend is still strengthening. The ADX is above the moving average and it's still going up, and the green line is on top. So we're kind of showing a bit of a mixed picture on the daily charts where in the short and intermediate term, we're dropping below the moving average, suggesting the trend is weakening. The green line's still on top, but we're still above 20. So it's a trending environment, but possibly a weakening trend. Here are some of the indexes that we follow. The Dow was up 1.3%, the NASDAQ up 1.4%, the S&P was up 1.6%, and another frustrating thing was the small caps ended up being down 0.8%. So here's some bullet points to go over what happened in the week. The S&P and the Dow did set new all-time highs. The NASDAQ and the NASDAQ 100 are close. The small caps and the mid caps, they've got a long ways to go. Most of the strength that we saw this past week was on Thursday. NVIDIA came out with their earnings. They were up 8.5% just for the week, and they were able to get over that $2 trillion market cap. No company's ever done that before. I remember when, I think it was Apple and Microsoft and those big companies, when they went over 1 trillion. Well, now we're starting to get up to 2 trillion. And believe it or not, NVIDIA is up 60% year to date. And here we are in the middle part of February. So that's kind of amazing. And then in conjunction with that, the semiconductors and the mega caps were up strong. That was specifically in Thursday's session. We did see a bit of a pullback in Friday's session. And now we're talking about this thing called FOMO. This is the fear of missing out. A lot of folks who actively are involved in the markets, they tend to react based on emotion to what's already happened. Oh, NVIDIA's up, I better go buy some. Oh, the S&P's up, I better go buy some. Well, when you do it that way, this often means that the party is just about over, at least for the short time. We don't use emotions. We don't even use intuition. At least my approach is that way. I try to look at the charts and have them tell me, no matter what I'm feeling, no matter what I have a hunch about, the charts are what I found over decades of doing this are the most reliable source, because a lot of times they're going to go against your emotion. It's going to tell you to buy when you think you should be selling. It's going to tell you to sell when you think you should be buying. All right, we did have some Fed speak. Fed vice chair, who's right under Jerome Powell, said that it will be likely to begin cutting rates later this year, but he's cautiously optimistic about the way inflation is evolving for right now. Also, Philadelphia Fed President Harker came out and said that he believes that they might start cutting rates, but don't necessarily look for it right now. The FOMC meeting minutes did come out in Wednesday's session. Didn't really tell us anything that we didn't already know. Interest rates ended up falling. They're still higher. They're up over 4%, but we did come down a little bit to 4.26%. That's when we look at the 10-year yield. And I've been showing this now for 6 or 8 months. This just charts in the blue area here, the blue line that you see, what inflation was doing. And yeah, it's been coming down, and we're still probably in this phase where inflation is going lower. The reason I keep showing that this chart is look at what happened after that. This is when we really skyrocketed up. We don't know if something's going to happen to really produce a lot of inflation. Of course, the perma bears, they just are certain that hyperinflation is right around the corner, but they always say that. But we just want to be aware that even though inflation was coming down in the mid 70s, we went through a really difficult time in the late 70s where we saw just inflation going up. So just be aware of that. All right. And we are above the 4.02% level, which according to RenMac, when we're above that level, that starts biting into corporate profits. Whereas I said before, we closed with the 10-year yield at 4.26%. Here is the poll, the first question. And if you have any comments or feedback that you want to give in the questions that I ask or the kinds of questions that I ask, please feel free. I make these up myself. I do not answer them myself. I want to see what people are responding. I'm not trying to manipulate any of the results. But the first question that I ask is, do you feel interest rates will keep going up or start coming back down? This was a week ago. 77% ended up being right. We did fall, not by very much, but we still did come down from last Friday to this Friday's close. And then I also asked, mega caps saw profit taking late last week and were underperforming the market. Do you feel this will continue with more weakness, or will mega caps rebound? 80% thought that there was going to be more weakness. And if you had looked at the market through Wednesday, that looked like that might be what was going to happen. And then NVIDIA came out with their report, and that just skyrocketed everything up. Also, small caps have been showing some internal improvements, mainly when we look at their growth to value ratio. Do you feel that this will lead to advances? 75% said yes, 25% no. Well, we had a down week for the small cap index. Most seasonal charts presented in the videos that I post suggest that there's a period of historical weakness, and it looked like that was starting to develop. But then we had Thursday's big up day and a little bit of an advance on Friday. But we could still go forward into some seasonal weakness from here, and I'll show you the charts later. So do you think this seasonal weakness is still to come? 80% say yes. And that's what history is telling us for right now. Couple of charts here looking at earnings. I update this every week, but the chart itself really doesn't change all that much. Just the bottom date does. And this is just projecting out not only by Morgan Stanley, but the consensus of the market that earnings are going to go up, and that justifies stock prices going up. I've shown different versions of this chart from time to time. This is just looking at the valuation ranges over a 20-year period of time, where for the US, this blue area, this is typically where the valuation ranges looking forward are at. And we're up well over 20. We're getting at 21.1 now. So that means even looking forward, the market is starting to get rather expensive. Then we have the whole world together and then different areas of the world, with the US having the biggest stock market and the most valuable stock market. It's not surprising to see this, but this is causing some concern. I deal with this more in the intermarket analysis video where I talk about valuations, not only what has already happened, but looking into the future. We are looking extreme positive, not only with some of the charts that we follow, but here as well. We're above this dashed line, meaning that folks are getting pretty exuberant right now. And we're seeing that in a lot of different areas. And when it gets to a real high reading like this is when we start to look at using this as a contrarian indicator. Everybody's positive, thinking the party's going to go. Our attitude is, okay, we're looking for a time to leave the party. Then looking at semiconductors, they're discounting a big jump in the ISM, but note different AI-driven cycle. What we're showing here is we have the ISM manufacturing, and that's the blue line. And it's below zero, but it has been starting to come back up. The lighter blue line here are the semiconductors, and they're really outperforming right now, where if you look at what's happened in the past, they tend to move in the same general direction and not get too far apart. We're seeing quite a bit of a disconnect. Is the ISM going to come up, or the semiconductors going to come down, or are we going to see a combination of the two? This is a chart, and I did go over this in a daily video. I've learned about this chart from Chris Schiavocco, who does a weekly video that I would recommend everybody watch. he takes a longer term view on things that I do. And if you want to focus more in the long term, his videos are very valuable. Well, he talked about this chart put out by NDR, and then I was able to find the chart on Twitter. And you might have already run across something, some of the, not necessarily perma bears, but you can take data and manipulate it and pretty much present whatever you want to show. And there's data to suggest that when interest rates go down, stocks go up. There's also data to suggest that when interest rates go down, stocks go down, because that's in reaction to things getting worse. And this tries to measure that. And when we have fast cycles, that's usually in reaction to something that's an emergency, like 9/11 or the great financial crisis or the COVID lockdowns. That's when the Fed just massively lowered rates. In fact, two of those times they lowered them to zero. And that's in response to something bad. We're in an environment now where the market is anticipating a soft landing. And so if the Fed starts cutting rates, they're doing it because they want to help the economy keep growing and not necessarily out of an emergency situation. And when the Fed does that, that's the dark blue line here at the top, and stocks tend to do quite well. When they lower rates because things are falling apart, then stocks tend to do not quite as good. Now, this is how it looks right now. This could change at any time. We could have some kind of an event, and just let your imagination run wild as to what that might be, that could really have an impact on things switching from, okay, the economy is still doing quite well, but we're still going to lower interest rates, to, oh my gosh, this terrible thing has happened. We have to lower interest rates to try to keep the economy from not going under. Then looking at the fact set, they just had one post. The headline kind of tells it all. S&P 500 companies are reporting year-over-year revenue growth for the 13th straight quarter. Over here on the right-hand side, this is the estimate of what it looks like they will be reporting for the fourth quarter. We're not quite through earnings season yet. Then looking at the intraday chart, where we did close for the day on Monday. So we started with Tuesday. We gapped lower and didn't really fall apart, but didn't really see a lot of advancing. And then we also were lower in Wednesday's session. And this is when you could have said, well, maybe the weak seasonality is starting to kick in. Then NVIDIA came out with their report, and the futures were up strong. That led to a massive gap higher. And instead of selling into strength, the market just kept going up. And then in Friday's session, we did gap higher. And this is a very important level that I'll address later on in the video. This is pretty significant overhead resistance, and we've been falling back from that. And the question that we're asking now is, have things hit this resistance and are going to turn back down, or are we going to be able to break above that? We don't know the answer to that right now. We just want to be watching for it. This is just for the 4 trading days of the week, looking at the different indexes. All of the indexes were up on the week, with the NASDAQ and S&P and NASDAQ 100 being up the most. Then this is looking back to the beginning of the year, where we have the NASDAQ 100, the NASDAQ, and the S&P doing the best. We still have small caps that have gone back to being negative on the year. Looking at our sectors, and the first chart that I show here sorts this from what was up the most, and we saw staples actually perform the best. And I go by the percent change here, and then we have materials, industrials, financials. There weren't any sectors this past week that ended up being negative. Now, in this next chart, I switch over to this last column, and this is a scooter score. The higher the number, the better this particular sector has been doing. And we see that communication, tech, and the financial sector, they're all into the 90s, where utilities have been performing the worst. They're right at 10 currently. And this is just looking at our relative rotation graph. Again, I always remind folks to think back to your geometry class, where you have an x-axis and a y-axis. When you're to the right over here, that's a plus. When you go above, that's a plus plus. So the strongest areas of the market are up in this area, where we do see communication and financials. They're green, and they're going up into the area where real estate had been doing better, but now it's starting to fall back. And we also have tech, which is showing a little bit of weakness here. And this goes back over the last year, way over on the left side. this is a minus minus, we do have energy that's been underperforming. Now I have another new chart. I'm just kind of trying this out. This is looking back over the last year at the different indexes. And I have a list of the indexes over here. Instead of the Dow, we use the Dow Jones Composite, which takes the transports, the Dow, and the utilities together. And this has actually been coming down a little bit, even though the Dow has been doing quite well. What I'm using a benchmark against this. And when this was originally developed, they used the Wilshire 5000. Well, that really doesn't exist anymore. It stopped last spring. So I'm trying to find something different where we can compare it to all of the stocks out there. And for right now, I'm trying the total US stock market, which has over 2,500 stocks. And I actually have a chart of this later on to show you. And this just shows how the different indexes are doing. We have the NASDAQ 100 doing the best. The S&P had been showing a little bit of weakness. But remember, we're not just looking at what's happening right now. We're looking at what has happened over the last year. So looking at the different sectors, this is just for the 4 trading days of the week where we had tech up and discretionary was unchanged. All of the other sectors ended up being down on the week. Going back to the beginning of the year, we have communication, tech. Those are the 2 positive areas. The financials have actually slipped a little bit negative. Keeping an eye on sentiment. This is another area that's starting to give us some concern. We closed at 78, both on Thursday and on Friday. So we're above 75 again. But we've been above this for a while. And in a good, solid environment like we've been seeing, we can camp out here for a little bit. That's why I say we entertain the idea of using this as a contrary indicator. We use other things to say, okay, maybe it's starting to happen. But this is one of the pieces of the puzzle that we use to put together to say, all right, at least at a minimum, the market is due for a pullback. Now, a week ago, it looked like that's what was actually happening. But then after Thursday and Friday, we really shot back up with sentiment. Also, the active asset managers. Now, this data is a little bit old. They had been getting extreme positive, and then they pulled back about a week ago. With the solid up move that we saw, this will likely go up in next week's reading. This is another look at that same chart. We're coming in at 74.7. It's when we get to 80, we start to take notice of this. And then when we get it above 100, that's when we really take notice of this. We also can use that as a contrarian indicator. When we look at the VIX on the line chart, we declined a little bit for the week, but since the beginning of 2024, we have been going up. Also, we are seeing a little bit of an advance with the bar chart of the VIX, even though it did come down this past week. The Ulcer Index is still giving a very low reading, also suggesting that there's not a lot of fear. Here's the RIDEX Bear Bull ratio as of Thursday's close. This is going down. That means folks are really favoring being in the bullish funds over the bearish funds. And you could make a case that they're starting to get extreme positive here as far as their sentiment. This is a few days old now. This is only updated once a week. This is the Investors Intelligence Bulls and Bears ratio, and we're above 3 and climbing. This is also suggesting that we're getting a little too optimistic. The American Association of Individual Investors, the latest reading, also about a week old, they're not extreme right now, and the red line continues to go up. Now, with the big move that we saw up this past week, it would not be surprising if they're starting to get more extreme positive now. But we can only speculate on that. What we have to act on is what we see on these charts. We're also looking pretty good with the black line going down when we compare cash to the tech sector. Keeping an eye on some different economic values here. We're going to get GDP in the upcoming week, and the current estimate is just under 3%. With the economists out there, the range in the top is about 2.5% to the upside and about 0.75% to the downside. I'm sorry, 0.75% for the low end of the range, but it's still positive. Then this is what a representation looks like for GDP. The big takeaway from this is that we're positive, especially in the first quarter of 2021. So, because one of the definitions of a recession is when we have 2 quarters back to back with negative GDP, and we're not seeing that right now. We're also continuing to decline when we look at the spread between risky and not as risky bonds. As this continues to go down, that just means that there's not a lot of fear in the bond market. We're also continuing to decline with the Chicago financial conditions. We get nervous when this goes above the black line. It's actually declining now. This reading is a little bit old. This is showing that they're lessening the tightening, the standards when you want to go in and get a loan. This also hasn't been updated. This is the real-time SOM recession rule indicator. We get nervous when we go above the red line. From the latest reading, we're just coming up over the black line. And then the smooth US recession probabilities, we're at the black line. We get nervous if we go up to the red line. And then looking at the Brave Butters, it's actually coming down. This was giving us some concern a little while ago, but the fact that this is declining is subsiding some of that. But this hasn't been updated since the 29th of January. Here's inflation, where we did get CPI in the previous week, and so we're seeing some adjustments taking place here. We're going to get PCE inflation in the upcoming week, so this chart will likely change. And then where's the Fed at right now? There's a 96% chance that when they meet on March 20th, which is still a ways off, that they're going to leave rates exactly where they're at right now. They're at 5.25 to 5.5, and the market is pretty much anticipating that the rates are going to stay the same. And this is how we've been seeing a change in that. There was some hope that maybe at the March meeting, there may be some cutting. This is a month ago, a week ago, a day ago, and then the current reading. Well, the Fed has pretty much come out and said, don't look at this really soon. And so that's why this probability has really been going up. Then looking at the meeting beyond that, at the May meeting, right now there's a 73.8% chance that they're going to leave rates the same. But this is going to change a lot between now and then. And this is also kind of becoming more of what the market is anticipating, where they had been expecting more of a rate cut. Well, it's shifting as these are going down and this is going up. So the market's a little confused as to when rate cuts may happen. And we don't even know for sure if that's what's going to happen. Something could develop between now and whenever the rates might get lowered that could throw a wrench into that whole scenario. We are seeing a decline in the Fed balance sheet. We're also, even though this is looking like it's ticking back up, we're still showing minus signs when we look at this on a year-over-year basis. Then looking at breadth, we are breaking out based on price, but we're not breaking out above these previous highs based on volume. And we're seeing this negative divergence with the daily charts as well. This is causing us a little bit of a concern. Yeah, we're positive here, but we want to see volume confirming what price is doing, and we're not seeing that here. We did see a real expansion of the new highs and not really an expansion of the new lows. So we're starting to turn back up with our 4-week average and our 10-week average. We're above zero and advancing with the advanced decline ratio. Looking at the smart money, the accumulation distribution continues to go up and is above an advancing moving average. Here's our trend. The ADX is above the moving average. When that happens, that suggests the trend is getting stronger. And then the green line is on top. And so that means that we would default to the positive trend. The Erin indicator continues to be positive. It's above zero and going up. This measures the difference between the green line, which are buyers, and the red line, which are sellers. And as the buyers peg near the top and the sellers are decreasing, that's what's helping this oscillator go up. The mass index is not generating a signal right now. Here's our daily chart, and I have another chart to show this a little more in depth here. But we were able to get back above the trend line after we had been falling below that. One thing that you'll notice on the bottom is, other than in Thursday session, in pretty much Thursday session, we've been seeing below average volume. Nothing has really changed on the decision point scorecard, depending on whether you look at their trend model or their PMO signals. There's another one that I've been starting to use recently. This is called the Keller market model. And we look at the S&P, the mid caps, small caps, and the NASDAQ 100, short, intermediate, and long term, and everything continues to be positive here. We are above the midpoint of the trend line and going up. So this is still very positive going back to 2009. This is kind of the big one right now. And I was trying to warn about this over the last few weeks in the weekly videos. We were getting, I dropped it earlier in the week because I thought we were going to keep going down. That's what it looked like was going to happen. But with the solid update on Thursday and then the slight climb that we saw on Friday, I have started including this chart again, and we're right up to this R1 level. Now, what makes this so important? Well, if you go back to late 2021, we hit one of these monthly pivot levels. Now, this is a weekly chart, so the pivot points that are on here go out one additional time frame. A weekly chart shows you monthly pivots. Well, we came right up here, hit this pivot, and then 2022 came after that, which was very difficult. Then as we were bouncing back up on late July of 2023, we hit this other monthly pivot level and then spent the next couple of months going down. We're coming up to this other level. Now, if we break through and go above that, that could be quite positive. But we also want to respect this because in Friday's session, we went right up to this. This is at about the 5111 level. And that was the high for Friday's session. They tried a couple of times to bounce us through that level. It didn't work. So if this is going to break through, it's probably going to happen. Well, we don't know when it's going to happen, but it definitely was not going to happen in Friday's session. So this is a chart that I'm watching quite heavily right now. And the cool thing about this is these lines are on the charts before this even happened. I was seeing this weeks ago and pointing this out in the videos because these are pre-drawn points of support or resistance. But when we look at the trend with the 50-week moving average, we see the S&P going up and the red line's going up, so that's a positive trend. With our moving average crossovers, we are positive with the S&P. We're coming back above zero with the McClellan oscillator, so that's turning more positive. And we're turning back up after being extreme with the summation index based on price. So this is still positive now, and we're turning back up a bit based on volume, and we're above zero with both. So this is positive. We did go back up with the Swenlin trading oscillator based on price and volume, and we're above zero. One little concern is we're breaking out with price, and we're kind of lagging right here looking at volume. The bullish percent index, it's not really showing a lot of strength. Here we are hitting all-time highs with the S&P, and we're not seeing an awful lot of an improvement with the bullish percent index. That's another potential warning sign. We did turn back up with the PMO based on price and volume, and we're continuing to go up when we look at the indicator by itself. We are showing some improvement with the PMOs that are rising and the buy signals, and we're flattening out after being extreme positive with the PMOs that are above zero. We're not extreme right now with the percent B. We did have one day after Thursday on the daily charts where we closed above the upper Bollinger Band, but then we dropped back down for Friday's close. The fact that we're above the midpoint and going up, that is positive. And looking at all of our oscillators here, we're still going up and we're really extreme with the slope. You could make a case that we're getting extreme with the TSI, we're getting extreme with the MACD. The PMO, not quite extreme based on where we were before. The PPO is positive, the TRIX and the KST. These are all positive, but they're starting to look extreme. And we're seeing very similar readings on the daily charts. So this is adding more to this overbought condition on different time frames. The Chaikin money flow continues to be strong and the red moving average continues to go up. You could also make a case that maybe we're getting to an extreme reading here as well. The Chaikin oscillator is extreme positive, where we're actually dropping down a little bit on the daily chart. This is another warning sign that we're getting overextended to the upside. The force index is positive. We're above zero and advancing and green. We did give an extreme positive reading with the money flow index, and it was pretty much flat this past week. With the rate of change from one week to the next since we had the up week, that is positive. And we're starting to get more extreme when we go back 50 weeks. We're also looking extreme with our 50-day rate of change. There's a big difference between 50 days and 50 weeks, but the fact that both of these are starting to get extreme, just something we want to be aware of. There are times when we can go way above these red lines. I put these red lines on here based on what has typically happened in the past. So there's nothing really magical about these lines. The RSI is looking extreme positive when we go back 14 weeks. The weekly chart for the special K continues to be negative, but it is showing some improvement where the daily chart is positive. We're extreme positive with the Stochk RSI, extreme positive with the Williams percent R, extreme positive with the ultimate oscillator. We are coming down, but still extreme with the vortex, but the green line is on top, so it's still positive. The Kopit curve, we've already gone negative on the daily chart, and we're starting to roll over here on the weekly chart. Nothing really to point out in this chart because we're above all of these other levels that may act as support if we see some weakness. This is one I've stopped showing this in the daily video. We've been chopping around pretty much for 2024. If this declines, that ends up being positive for the market. If this goes up, that's more negative, and the market is really indecisive right now. This going up is also somewhat negative. When we look at the VIX and a 3-month average of the VIX, when this is going down, that's positive. When this is going back up, that's more negative. But when we look at the trends with the Heiken Ashi, we are looking pretty positive here longer term. We're also pointing back up with the Kegi chart, and it's black. That's positive. The Renko continues to be positive, and the 3-line break is also positive. We look at the ease of movement, where it came down just a little bit, but we're still above 0. And we did have a couple of new X's drawn in with the point and figure chart. We also saw this in Thursday's daily point and figure chart, and then Friday we went up just enough to generate a new X. That's always positive if you're positive on the market. And we're still working off of a double top breakout from the November 20th, 2023. That's the same signal that's being generated on the on the daily daily point and figure chart. And this is a weekly point and figure chart. The other chart is a daily version. So looking at our longer term trend, long term, we're looking good. Intermediate term, we're going up slightly. And we did see a bit of a bounce in the short term. But this is also based on a weekly chart. So it's automatically going to be longer term. We are back to positive now with the Elder's Impulse system for the S&P. And this is interesting. On the daily charts, we actually switched negative for a few days on the parabolic SAR. Then after Thursday's session, we switched back to positive, and we continue to be positive on the weekly chart. And then here's some daily charts. This is a bit of a concern. We're seeing the red line above the blue line. The blue line is growth. The red line is value. In a good, solid environment, we want to see the blue line outperforming. Also, another intraday chart. We really shot up when we opened in Thursday's session, but then kind of chopped along sideways as the market kept going up. We did spike up right in the open in Friday's session, but then started coming down and actually finished negative with this ratio. We have been seeing some improvement with small cap growth to ratio, and these are end of day charts. But if this continues to fall, that could give us a little bit of a concern. We're looking a little more positive here with the mid caps, but even though they were falling, they were flat after Friday's session. And we're turning down just a little bit with S&P growth to value ratio. And this is a daily chart. The longer we can stay above these two lines, the more we might see a golden cross. But at the same time, the S&P is going up and setting all-time highs. We haven't even surpassed this previous high set earlier in 2023. And then when we look at discretionary versus staples, yeah, we ticked up a little bit, but we're not breaking out. So it's really underperforming the price of the S&P 500. Another warning sign. Here's the 5-period equity put call ratio, which is continuing to go up. That is negative. And we've been watching this for quite a while now. This is the correlation between the VIX and S&P. We're still above this dashed line. And we don't know, is this going to continue to go up? But at some point, when this spikes out and starts to come down, look at the other times that I've marked on this chart. And that typically, not always, but typically can be short to intermediate term negative. And just in case you didn't get it, oh, this is the daily chart of the parabolic SAR. Where we did see the dots on top, now we're seeing the dots underneath. That's turning back more positive. This is a new study that I've been watching every day, but since I focus more in the intermediate term, this is short term. This is the 20-period study, and these are stocks in the S&P that are above their 20-period moving averages. We have been seeing a negative divergence here. The S&P has been going up as this was going down. Now we're seeing some improvement here, but we need to see a lot more strength out of this to suggest that there's really some conviction behind any upward moves with the S&P. This is that same idea, but the top area, that's the 200-period moving average, and the bottom area is the 50-period moving average. We are diverging negatively compared to price with both of these, but we are also now seeing some improvement. Here's the trend line that is a little easier to see. We actually dropped below it earlier in the week, but then in Thursday's session, we blasted back above it, and we're still above that level now. If we start to see some weakness, this is the first line of defense that we're going to watch to see, are we going to break below this? Because not too far underneath this will be the 20-period moving average, which that will be the next layer of support that we start to follow. This is a new chart. Also, I got the idea from this from Chris Shavako's video, because there's been, and I'm even guilty of this myself, that there's 7 stocks that are pretty much responsible for all the rise in the indexes. And to a degree, that's true when you look at the S&P and the NASDAQ 100. Well, this is probably the biggest ETF I could find. It represents 2,651 stocks. This is the total US stock ETF. Now, if there was only a small number of stocks really controlling everything, would we have broken above these previous all-time highs and now setting new all-time highs? No. So there is strength in different areas of the market. Now, the big stocks like Nvidia, Meta, Facebook, I guess that's the same thing, and Microsoft, yeah, they're weighted heavier, so they're having a lot more of an impact on things. But the fact that this is going up does suggest that there's some broader strength in the market. And then another thing that you may come across is called the Hindenburg-Omen. I've switched my attitude just a little bit with this. My problem is this is something that the perma bears just love. And they latch onto this and they build their entire scenario around this. And there's another chart later on that, and I have a real problem with that. When you look at one detail of the market and try to come up with a big picture conclusion based on a small part of the overall picture, that can be a real mistake. But the Hindenburg Omen, this is the definition, and how it's calculated is over here. And really, when you take the Hindenburg Omen by itself, it's only right about 25% of the time, and that's not good enough for me. According to Investopedia, if you use this, you want to use it in conjunction with some other charts. That's why I'm kind of having a bit of a change here. I'm not basing everything on what I see in this chart. I'm looking at it, and when this starts to really make some noise, I'll tell you about it, but I'm not going to base everything around this chart. Here is the actual chart. And the reason I decided to go ahead and create this is at stockcharts.com. If you go back to how this is calculated, there's a number of different things they put together. Well, at stockcharts.com, they've crammed all those things together and made it into one indicator. Now, we did see a spike up, and that is a caution. What we need to see now, and this is right around the first part of February, before the first part of March, we need to see another spike up, and that would be a Hindenburg Omen. If we don't get another spike within 20 trading days or about 30 calendar days, then this would be a negated signal. And there are other times when this did okay. We saw a cluster of signals back in 2019, and then we saw a bit of a decline here, but nothing too astronomical. Now, the perma bears, they think it's like the end of civilization as we know it. We had a significant downturn here, but nothing all that astronomical. The one that they like to latch onto is we saw a whole bunch of these clusters right before the COVID crash. But then we V-bounced out of that. But oh man, they were pleased with themselves when they came up with this, thinking that they have an insight in the market that nobody else has. And we also saw this in late 2021, right before we had a difficult 2022. So looking at this, and when we look at multiple signals, yeah, this can be somewhat helpful to us, but I'm not going to base everything around this chart. All right, some broad market measures. Here's seasonality. We're in the month of February, where it tends to be the weakest of the 6 best months. Then looking at just a regular chart of the S&P on top, which is setting new all-time highs. We're not setting new all-time highs, but showing some improvement here with the mid caps. And we still have a ways to go here with the small caps. So on a longer term time horizon, the mid caps and small caps are not confirming the all-time highs that we're seeing in the S&P. But the Dow continues to be in an uptrend, set another new all-time high in Friday's session. The NASDAQ is getting close, but not quite there yet. And maybe this will act as overhead resistance. Maybe we're going to come up and hit this and then start to go down. It would be a lot more positive if we could come up here and break through it. That would confirm what we're seeing in the S&P 500 and the NASDAQ 100. The NASDAQ 100 is really close to all-time highs and is in a really solid uptrend. Here's a weekly chart of the Qs, also looking really close to all-time highs. The mid caps are still in an overall uptrend, but have not surpassed these previous highs. We're still in an uptrend with the small caps, but we have a lot more previous prices to get above before this is going to look more positive. The NYSE is going back and now setting new all-time highs. All stocks also setting new all-time highs. The 30 biggest software companies are now back in a more solid uptrend. The FANG index is coming off of setting all-time highs. ARC is kind of bouncing around here, but it's still in a longer-term uptrend. We're keeping an eye on the banks. It's been chopping sideways now for the last few weeks. We're still above 50 with the RSI, but we're starting to roll over, but we're still positive when we look at the momentum. And then here's the deposits in all the commercial banks. I look at the number up here where it's still a minus. There's more money going out of banks than is going into banks. And here's just a generic look at Dow theory, where we are setting all-time highs with the Dow. We haven't even come back to this previous 2023 high yet with the transports, let alone the all-time high set in 2021. And the utilities, which I include as part of Dow theory, they've been under a lot of pressure lately. Some broad market measures. Here's the CRB index, which has been chopping sideways, but is in a longer-term downtrend. Oil has just been bouncing around in the 70 range, not really breaking out, not really breaking down. Copper is still chopping sideways as the economy figures out what it wants to do. The dollar did see a bit of a rebound, even though it turned down a little bit this past week. We're also seeing some improvements with the daily chart. And the fact that this is going up could put pressure on stocks. Stocks like a weaker dollar because of the conversion rates and what happens with imports and exports. It looks better on their books. Gold was up on the week and is still in a longer-term uptrend, but far from really breaking out when we look at the ETF. And I do listen to a few folks they're like gold bugs. And no matter what happens to gold, they can always justify it away somehow. And silver still going more in a longer-term downtrend, and it's pretty much been chopping sideways here. We are showing a little bit of an improvement with the total bond ETF. We're in a longer-term uptrend. We started to see some real declines earlier in 2024. But when you compare stocks with bonds on a monthly chart, stocks are outperforming. And we're still positive with our 1 month and then we subtract the 3-month yield. Could it be this banking thing that really has yet to hit other than the New York Community Bank? I don't know. But the fact that this is positive when it should be negative, and it's been that way for quite a while now, is a concern. Here's a look at the daily chart of the interest rates as they were going down, then we were going sideways. Now we've been starting to go back up, but we did see a little bit of a decrease later in the week, this past week. Here's a weekly chart showing with the US, UK, and German rates and the Japanese rates, which are for the most part going back up. This is a chart that I've been showing for a while. This goes back to last October when we hit the low, wondering, is something going to develop? Because other times when we spiked and went down, usually something bad happened after that. But to this point, it hasn't happened yet. And then here, this is another point when rates really spiked up and then started to go down. And it was usually because of some negative thing that happened, but we're just not aware of that right now. There might be people that know. There's a lot of people that think they know, but until the market has some definitive news that it can react to, we're kind of dealing with an unknown right now. Some relative studies, we start out by looking at an intermarket analysis chart going back to the beginning of the year. Oil did decline, but it's been performing the best, followed by stocks, the dollar. Gold did go up, but it's still negative year to date, and bonds are going up, but still negative year to date. When we look at a ratio between the NASDAQ 100 and the S&P, the NASDAQ 100 is outperforming. They're both doing really well. The NASDAQ set earlier all-time highs. The S&P set new all-time highs in Friday's session. But there's a lot of overlap. There's a lot of stocks in the NASDAQ 100 that are also in the S&P 500. The S&P 100 is outperforming the S&P 500. Growth continues to outperform value. And gold has really been underperforming the S&P. Gold has also been underperforming the dollar, even though it ticked up a little this past week, as we saw a little bit of weakness in the dollar. And on a shorter term time horizon, this also shows where bonds are underperforming stocks. Low volatility compared to the S&P has really been underperforming, even though it bounced recently. Discretionary to staple shows that discretionary is outperforming, but we're not seeing an awful lot of strength in discretionary either. And a lot of that has to do with Tesla. Then when we look at a ratio between the energy sector and the tech sector, this shows that energy is underperforming. And then here's our longer term cycles, where this is indefinitely on the books. We had a signal that was generated last October 2022, and we're still looking at that going forward. We also had two ZWAG NYSE Brett thrusts triggered within the last year. Those we're getting up to the year point here now. That'll be in March. But then we had another one that was generated last October, and this is positive going forward. The Zohorchak method still is on a full-blown buy signal. This is a trend line of a weekly chart that I drew from the 1987 crash, and then I connected the .com bust low, and then just extended that chart going forward. We're above this now, so this is a longer-term trend line that we're still above. Here's a blow up of that just going back a few years, showing how we're well above the trend line. We look at the new highs, new lows for the NYSE. We're above zero and advancing. That is longer term positive. We're also looking positive here when we look at the 50-period moving average of the new highs minus the new lows. Those continue to go up as well, and that's longer term positive. With the NASDAQ 100, we are also above this weekly trend line here. That's positive. This is another chart that the bears are just, I watched a 10-minute YouTube video where you could have said in a couple of less than a minute, probably what I'm going to say here, but it was drawn out for a long time, and they're building a whole scenario around this chart. Now, I can understand that, and it may end up playing out that way. But to use just one chart and base everything off that, I think is rather dangerous. This is the NASDAQ 100 to Dow ratio. And this is when we were going up with the dot-com boom. And this is the dot-com bust. And then it took us many years to get back up. We also hit this level again, right, in late 2021. Then we went down as we really suffered in 2022. Now we've been coming back up. We've been near this line, but now we're starting to touch this again. Now, could this turn and go down and really lead to some negative things in the market? Of course. But we also want to use other charts to reach our conclusions. If we break above this, that would even be more positive. This is a similar chart where we look at the QQQs and the IWM. This is the NASDAQ 100 to the small caps, the Russell 2000. We did come up to this line and we're starting to come back down as small caps have been underperforming. Is this going to cause a problem? We don't know yet, but we just want to be aware of that. We are still seeing an improvement with the cumulative new highs and new lows for the NASDAQ. We're also kind of topping out here with the 3-month yield, where when we got at this level and then started to come down, that led into the great financial crisis. If we really start to go down, this would be a reason why the Fed would lower rates, because something terrible is happening. And for right now, it's not necessarily giving us a warning sign. We just want to keep an eye on this anyway. And then this is just for Monday's session. This is the outlook. On the daily charts, we're positive with the technicals, but we do have a kind of long list of being overbought in the short, intermediate, and even a couple of long-term indications. We're dealing with that overhead resistance. And we're also seeing some weakness that's developing under the surface on the daily charts. And we're also in that period now of weak historical seasonality. We will get new home sales on Monday, and then we want to keep an eye on the geopolitical events. The market isn't really paying attention to these things, but that could change at any time. Here's the economic calendar for the upcoming week. We are going to get the second estimate for GDP on Wednesday. It's probably, if it comes in the same as the first, or the advanced reading, it's not really going to impact the market. If it comes in a lot different, it could freak out the markets, either good or bad. The big report is going to be PCE prices on Thursday. We're also going to get ISM manufacturing and consumer sentiment on Friday. Here's seasonality. This is just for Monday, February 26th. We're neutral to positive with the Dow and neutral to negative with the NASDAQ. So we're right around that 50% level. And then this is a Carson chart showing how we do see some weakness as we go throughout the month of February. Doesn't mean we go straight down. There are little bumps up along the way, but we really haven't seen that kick in. It looked like it was Tuesday and Wednesday this past week, but then Thursday and Friday kind of took that off the table. And then here's a longer term look where we might see some weakness that could go into the middle to latter part of March. The gains that we see during an election year usually will end up happening after that. Also seeing kind of that same thing with the Stock Traders Almanac. This is when the sitting president is running for re-election. That's the green line where we could see some historical weakness going forward till the middle to latter part of March, where February tends to be the worst of the best 6 months. We will be on the 17th trading day of the month in Monday's session. We do see a little bit of negativity with the green dashed line for the S&P. And then Tom Bowley has his research where, based on what he's found for the S&P, the rest of the month of February is negative. This is put out by Dan Bird. The area that we're watching right now is the latter part of February and possibly going into March. And then this is a chart I've been showing for a while because 1982 was bearing a resemblance to 2023. In 1982, good things ended up happening after that. We don't really know what's going to happen after that right now. And then looking at the performance for the month of February, we're up a little bit more than down, but we do end up having a negative return for the month. So we're not going with the down scenario yet. We could pick out a lot of these bearish things and weakness that we're seeing in the charts, but we're not seeing really any confirmation of that yet. We are, if anything, going with the up scenario, but we always want to buy into strength. Only we don't want to buy the dips. I'm not a believer in that. And then we're not going with a sideways trend in the daily charts because our ADX, even though it's weakening, is still above 20. Warning signs. What we've been seeing over the last week or so is on the up days, volume is decreasing. Now, there was the exception in Thursday's session, but we were up in Friday's session and we were below average with volume. The risk on posture chart is just not helping us right now. The equity put call ratio based on 5 periods is going up. That's negative. Our oscillators on the daily charts, most of them are extreme positive, but they're still dropping below their moving averages. Some of them are starting to turn back up, but if they do turn back up, we're still extreme positive. So it's like, where are they going to go? But this can happen when we're in a good, solid environment. We're also seeing some negative divergences in those charts. We're also seeing negative divergences when we look at the McClellan oscillators and summation indexes when we compare them to the S&P. The Kopit curve is negative. The NASDAQ 100 bullish percent index, it finally dropped below 70, even though it ticked up a bit in Friday's session. The momentum for the NASDAQ 100 is improving, but it's still negative. And small and mid caps, when you just look at the indexes, they are negatively diverging from the S&P. The discretionary sector is also negatively diverging. The transports are negatively diverging from the Dow and S&P, and I'll probably cover that in the intermarket analysis video. And we are entering a period of historical seasonal weakness. Long term, those weekly charts with the S&P and the NASDAQ 100 were above those trend lines. I'm saying that they're warning signs because if we fall back below them, selling could really pick up. The 1 to 3 month short-term bond spread continues to be positive, and I'm not really sure why. We're above where we were back in 2007 with the 3-month yield. Wondering, the context is different for right now. Now, that context could change at any time if something really negative happens where the yields really starts coming down, but we're not seeing that yet. And then earnings can be either positive or negative. The positive signs for right now, when we look at small, mid caps, large caps, growth is holding up for the time being. The parabolic SAR chart has switched back to positive. The oscillators, even though they're extreme positive, well, they're positive. And so that is usually a good thing. The vortex is still positive. Small and mid cap growth is still hanging in there for right now. The financial sector is positive as well. Long term, we have our daily special K chart, which is positive, but the weekly chart is negative. Our longer term 253 period equity put call ratio chart, it's bouncing around and it's really unclear whether it wants to go up or down. The Zohorchak, though, is still positive. The Russell, the small caps, and the mid caps did generate golden crosses. So they are still in longer term uptrends. And then our 50 period new high, new low study is positive. Our other study of the new highs, new lows, which is longer term, that's also positive. The cumulative new highs, new lows for the NASDAQ are improving. We did see 2 ZWAG NYSE breadth thrust buy signals that were generated over the last year. And February ends up being the worst of the best 6 months. There we go for that. So these longer term positive seasonality and setups, those are still in the background and they're still on the books. And that's giving us a longer term positive perspective, at least for right now. So our conclusion, we're positive, but we're overbought on all the different time frames. We do want to deal with that 5111 level for the S&P 500. Right now, that is pretty significant overhead resistance. We are seeing some weakness starting to develop, and we are in a weak seasonal time. That's what we're watching in the short term. We're watching this in the intermediate term to see if there's going to be more weakness that ends up developing. We're still positive in the long term, but we are overbought. We have a daily 150 and 200 period simple moving average that are extreme positive. Thank you. I really hope you found this helpful. Please feel free to check out some of the other videos that I post. I hope you have a really good weekend, and I will talk to you in the next video.